All right, welcome everyone. Episode number 22 of the Wide Lens podcast. I've got Matthew Rigby here.
Welcome back.
And we're going to cover the latest
Welcome
topics.
back to us.
In investing and financial markets. Episode 21 is a phantom episode. No one will ever hear that episode.
Lost.
It is lost in the ether. And so, sorry about that. We'll just jump to episode 22 from 21.
Not sure
it is a mystery, but we're back here live anyway.
User error, I think, is the issue.
Not quite. Some wild predictions were made in that episode, and we'll never hear them. Nice jumper, Matthew.
Yes.
Looking good.
Thanks, man.
Yeah.
It's feeling all right. I'm about to have a crack at you. So
Right, with the Celtics.
It's the Celtics.
Recording this on Friday, the 24th of June.
Bloody hell.
And we're going to get straight into – there's a lot to cover today because 21 was a phantom episode.
Yes. So we've got a bit of a hybrid episode.
Let's get into
22 mashed up together.
Yeah.
Firstly, congratulations to the Golden State Warriors beating the Boston Celtics to the NBA championship.
Yeah.
I was very happy about that.
Did you see the guy with a tattoo with the
the Celtics tattoo?
championship
makes me so
tattoo?
happy. Good to see Celtics fans lose. And NBA draft today, rocking the Knicks hat. Let's go Knicks, trade up. Anyway, enough of the basketball talk. Get on to the markets. So the last 5 days, the Aussie market I've got as down. Actually, let me just quickly check that. I think maybe I forgot to update that. Up until last night's close, last 5, down 1%. Which surprises me.
Why is that surprising you though?
Well, because the US markets have been pretty strong this week. The US is closed on Monday.
Yeah, but don't forget that Aussie market's rallied pretty harder than the US market. Like if you look at Aussie value stocks, they've rallied pretty hard in 2022.
Yeah, that's true. Yeah.
So relatively speaking, maybe, giving up some of the gains.
Yeah, down 1% for the week, still down 14% for the year, which is better than,
Better than
most other markets. A few stocks in the news this week. PointsBet Holdings, the gambling company that's really making a big push into the US. SIG announced a big investment of $94 million at $243. So the shares are currently trading at $244. I think prior to the news, they were trading close to $215, maybe even $2. They're up 25% for the week. So SIG have a sports investment arm. They also do a lot of data analytics, which I think PointsBet wanted to sort of tap into to offer more markets, more betting options, more in-game betting play for the US market. In addition to that, they announced a deferred bonus equity option. So 20.2 shares for every share that you hold, I think it is, but you get to buy them at $10 less a 20% discount in July 2024. I guess the key thing to note there is they've had options in the past, and I don't know that they've ever been in the money when they expire. So probably don't get too excited.
Not a good track record.
Not great. Vicinity Centers came out with some really good positive upbeat earnings and outlook guidance today. So they're the shopping center operator. And that's had a pretty positive effect on the rest of the listed property trust sector. They're up at about 11% for the week. And
probably shopping centres that they own the old Centros, aren't they? Yeah,
I think so.
It is. I know. I'm sorry. No. I don't know. So Bankstown Central, Bayside down in Frankston.
They've got quite a few.
Chadstone, DFO Perth, Emporium. Yep.
They also do a bit of property development stuff as well.
Yep.
So look, I mean, positive, maybe it's a bit of confidence that shoppers are back out in force. Linus Corp, this was announced last week. I'll cover this because no one heard it, but they secured $125 million US contract with Department of Defense in the US to build a processing plant in the US, probably in Texas, I think is where it is. So they're the only major processor of rare earths outside of China, which is pretty important because rare earths kind of feed into everything these days. So that's pretty important. Expected to be up and running by 2025. Uranium. So I know there's some people out there that like to dabble in uranium. uranium stocks, not uranium. Paladin down 13%.
Slightly dangerous.
ERA down around 26%. Boss about 13%. And the energy sector down.
Who was that uranium company that IPO'd recently?
Yeah, and they're down.
And they felt like
50% on the first day. Maybe it was even more. I can't remember. I did see that. I should have thrown it in. Getting belted. Energy sector down 4.6% this week after being down 7.75 last week. So finally joining the big market sell-off.
Mate, diesel still $2.33.
Yes. Yeah. Well, it's funny, isn't it? Petrol prices go up pretty quick and they're pretty slow to come down. So come on, petrol stations, get your shit together. All right, the NASDAQ over the last 5 days up just under 4%, still down 29% year to date. 79 stocks are down more than 10%, 12 in positive territory. The S&P,
can you run the numbers not more than down 10%, more than down like 20% or 30? Can you do that? Is that easy to do on Refinitiv? Not now, but
well, I've got the numbers sitting right here if you really want to know what they are.
I was just more curious. Maybe I feel like down 10%. Is that for the week?
No, year to date.
I feel like that number's irrelevant now.
Yeah,
like
that's not enough.
No, I think the number needs to be
62 down more than 20%.
62% of stocks.
62
companies
stocks in the Nasdaq 100.
Oh,
so
the
62%.
Yes.
In the Nasdaq, down more than 20%. 44 down more than 30%.
44% of stocks, almost half stocks are almost
of the Nasdaq 100 down more than 30%.
Can you have 40%?
I do. I can keep going, man. I do this all day. So 40%, we've got 27.
So 1/3 or 1/5 of the 1/4 of the companies are down. Wow, that's a big number.
Yeah, and 11 down more than 50%.
Yeah. Well, I've got some stats I want to share as well shortly, but let's keep going.
All right. So, and so the S&P up 1.8, down 20% for the year, 21% for the year. 83 are in positive territory, and 349 or 70% down more than 10%.
Stock pickers market, isn't it?
Yeah, so the US markets are only open Tuesday and Wednesday. This is all up to Wednesday's close. Doesn't capture last night, but pretty interesting. Some stocks to talk about. Kellogg's.
Oh, yeah, I saw that.
Up about 3%. So the maker of Rice Bubbles and Pringles announcing a 3-way split. So they're going to basically create 3 companies. There's a snacks business, a cereals business, and a plant-based business. And if you're wondering which is the better one to invest in, I always say go with where the CEO is going. If you're splitting your company and you're the CEO and you get to choose, you're not choosing the one you think is going to do the worst.
But what insight does a CEO have that?
Well, surely he's got more than.
Well, I guess that's only his or her opinion of what that business is going to do.
Yeah, but on long-term plans, I mean, they'd see. Anyway, he's going with the snacks business. So, Rob,
can't go wrong. Do you know what the CEO wants? He doesn't get kicked out of a job.
Of course not.
Yeah. So, why would you go?
Why would you go the plant business that's the smallest, or the cereal business that's in decline?
One, you're probably not going to. Yeah, it's. I feel like it's the middle of the road.
Yeah.
Where's the upside though?
The smart choice.
Where's the upside here? Do you reckon
that he keeps his job?
No, the upside business. So why do you think cereals are going down?
Yeah, there's been a bit of a shift away from cereals. You know, people having cereal in the mornings. There's been a trend for the last, I don't know, maybe 10 years. It's been a pretty consistent.
Is that your own trend?
No. This is legitimate. I'll find the stats. We'll have a look at that. No, but that's across all those cereal brands, I've been seeing that.
I think they said the plant-based business they want to sell off.
Yeah, likely to be sold off. But what do you think they're going to call each of the businesses?
I don't know.
Snap, Crackle, and Pop.
What's
Snacks, Snacks, Cereal, and Plant. How good is that?
Who came up with that?
I did just then.
Bullshit. Did you really?
Yeah, I was looking at it going, oh yeah, for sure, Snap, Crackle, and Pop. That would be so awesome.
Did you really just come up with that?
Yeah, man. Well, not just now, but when I was looking at it, I was like, oh, they do rice bubbles. Oh,
I can see your notes here. Snacks, cereals, and plants.
Yeah, see that? I tried to give you a little hint, but you're a bit slow on the uptake.
Wow, that's...
anyway, we'll see.
I can see
maybe
company here.
I'll email the CEO, see if he's up for it. All right, some other news, and this was one I mentioned last week. I wanted to keep this in.
Oh, that's right.
So Walmart announcing an exclusive deal with Roku. So essentially, Walmart and Roku are teaming up. Roku advertises stuff to buy, and Walmart ships it through their delivery program. Roku, the online TV platform. So
that's right. And we talked about this. And,
you were like, hang on, people have a phone.
Well, who's going to buy stuff off a TV?
Well, anyone that's sitting there watching it.
I just don't think anyone's going to buy stuff off the TV.
I disagree. I think they will. I think there's people out there that, we're becoming lazier and lazier. So if I don't have to pick up the phone to order something, I can just go bang on my TV.
What do you mean you go bang on your TV?
With your remote, go buy.
You must have a very advanced remote. I
think a little button. I don't know.
I don't know.
Remember I bought my TV and it took
that's right.
4 months for them to.
That was at the very beginning of the bottlenecks. You were first-hand experience with just complete incompetence by the good guys.
Absolutely. Anyway, so that was interesting. Darden Restaurants came out with earnings. So they run Olive Garden and Longhorn Steakhouse in the US. Why I thought this was interesting, they beat earnings, they raised their dividend by 10%, and they announced $1 billion share buyback. So that's a pretty big vote of confidence for US consumers. They're in the restaurant business, so they're going to see that, if consumer spending stops, presumably they're going to see that firsthand. And Target clearing inventory, but they also announced a 20% increase in their dividend. Somewhat interesting. And lastly, DocuSign CEO announced he's leaving. Always a nice sign to see your shares up nearly 14% after you announce you're leaving, but still down 60% year to date. Emerging markets up 1.6 for the week, down 13 for the year. Oil down 4.8, let's call it 5% for the week, down 3% last week. Still up 38% year to date, but that was as high as 56%. And 104 US a barrel.
Did you see Biden come out saying, asking Congress to provide a 3-month
holiday on the petrol excise? Yeah. ScoMo's ahead of his time.
He's ahead of the game.
Pity he can't take glory for it now. He's in the wilderness.
Very strategic here in Australia.
And lastly, Bitcoin up 11% for the week. They were down 28% last week. Still down 55% for the year to date. 21,076 US dollars a coin. And something of interest, we've got a few things here. So Elon Musk, along with SpaceX and Tesla, are being sued for $258 billion over claims that they're part of a racketeering scam to back cryptocurrency, the Dogecoin. Yeah. I would say anyone backing cryptos is part of a racketeering scam, and bloody sue them all.
They got no money left anyway.
No, exactly right. And we'll just bring up this chart here. This is from B of A's Global Research. I found this. Hans Lee is a dude that put some stuff on Livewire. He had this, which I thought was interesting. History of asset bubbles. Not really history. It only goes back to 1977. But just the magnitude of the Bitcoin move kind of caught my eye. Also, ARK and FANG stocks are in there. That was interesting. China Tech. Anyway, a few things in there that I thought was just interesting to see that kind of magnitude more than anything.
Well, I saw you updating the notes, so I threw one in there for myself, and I'm going to bring this chart up. So this shows how many addresses store any Bitcoin at all.
Okay.
And so the interesting thing that I found is that if investors are capitulating like they are now, we have on record the number of households holding any Bitcoin at all. We're almost at 30 million households now. This looks at unique addresses globally.
Mm-hmm.
And so why would that be rising versus Bitcoin capitulating? So if you've got the likes of retail investors buying, I was actually thinking about this. Do you remember when a lot of the investment banks and big US banks started getting into crypto and Bitcoin?
Yep.
Is that smart money really dumb money? Did they buy
at the
absolute peak and they've just sold off and capitulated because they've had to as part of their mandates? Meanwhile, you've got retail investors. And if you look at any of the surveys that are done about investors, depending on their age group, the millennials and earlier, and as you get older, the outlook for Bitcoin and its relevancy just diminishes. 65 plus is like,
90%.
This is no relevant in our world and we don't see it being relevant in our lives.
Yep.
maybe that. Yeah. So I don't know. I thought this was really interesting.
So looking at that goes up to somewhere earlier than May, I would presume, based on those dates. Remember earlier this year, you commented that Bitcoin had held up really well relative to other assets, and then it just fell off a cliff. I wonder if it would be interesting to get an update of that chart.
Yeah, this is the latest one we've got available.
But, yeah, pretty interesting. Did you put this one in as well?
Oh, yeah. So I just something I'll bring this one up as well. This is what gives me some degree of not pessimism, but just feeling like this is just people who just don't know what's going on. Many. I'm going to read this now. This is Pomp on Twitter. Many people are now yelling, "Why is Bitcoin going down? But inflation is high. Inflation hedge failed." Wrong. Bitcoin and other assets are crashing in anticipation of inflation coming down. Investors understand what the Fed is doing. They are moving in advance of the results.
What a load of shit. Who the hell is this person?
What is that? I don't even know what that even means. It makes no sense whatsoever. And when I see stuff like this, I think
it's got to be a piss take, right?
This is not. Anyway, look, let's get into the first topic. The second worst period on record. I'm going to bring this chart up now. This is a 60-40 portfolio. So 60% of your assets in stocks and risky assets, and 40% of your portfolio in bonds and defensive assets. And this chart's from Bespoke. It's a second worst period for 60-40 on record. Couple of highlights here I want to just read out from Bespoke. 60-40 portfolios are down 17.8% year to date on a total return basis, the worst start to a year since at least 1976. That 6-month decline makes this second worst period for 60-40 portfolio returns since that time. Unlike prior declines, which saw lower interest rates offset some of the equity bear market pain, bonds are not insulating returns for investors.
Yeah.
And so when you're sitting there historically, you look at the paper, you look at the data which says holding diversified portfolios. It doesn't matter, and we've run numbers. It doesn't matter where you've invested. 2022, most country stock markets are down. Yep. Most bonds are down. I think Brazil's up. Brazil's stock market is up during
Q1,
22.
Right? Or more recent?
No, I think it's more recently. Okay. We ran the chart. It's Brazil, Portugal, Norway, and Singapore. There are 4 stock markets that are up in 2022. Every other market is down. There's literally been nowhere to hide, and it is. And Bespoke talk about the amount of wealth destruction that we're seeing at the moment. I want to read this to you from Bespoke, because I'll talk about a couple of other things shortly. Of course, investor sentiment remains historically bearish after such large declines, and we definitely aren't hearing anything positive from the market commentators that have been bullish leading up to the peak 6 months ago. In terms of historical analysis, most of our work shows that if you have longer than a 1-year time horizon, now is a time to be putting money to work rather than raising cash. Remember, the goal is to buy low and sell high, not buy high and sell low. There's a reason the phrase "buy when there's blood on the streets" came into existence. Historically, it has worked. While there isn't an official blood in the streets indicator, maybe we'll create one, we think the second worst period for 60-40 in 50 plus years at least comes close to qualifying.
Yep.
What do you think about that?
Yeah, I agree. I mean, we talked last week, and again, you'll never know whether we did or not, but we were saying, 12 months out from now, do you see the numbers? Yeah, do you see the market being up or down? And
can you understand why this is really painful for a lot of investors, especially retirees who are drawing on their super funds, pension funds who are sitting in a 50-50 portfolio, 60-40 portfolio, whatever it is?
This is all well and good if you're confident you've got the time horizon to ride it all out and see the recovery.
Yeah.
And if you're not, if you're, I don't know, older, I won't pick an age, but there's, there'd certainly be some feeling that, shit, are we going to, as we're pulling down, the value's dropping, are we going to be able to ride this out? I 100% get that concern.
And especially as inflation roars as highly as it's roaring, petrol prices are where they are.
Off the charts, yep.
Talking to clients who are telling us that their bread's going up.
Oh, that's right.
By 30% or whatever it is.
Yep.
And this is real. This is real life, real concerns that people are having right now.
Yeah, I think the stock market going up and down is one thing, but when you start seeing it, my wife was at the supermarket and she was like, you can't buy lettuce anywhere because they can't get it in. Prices are so high, but there's just once it's gone, it's gone. And so we're seeing, and we've seen this in Europe. There's big food shortages over there, and prices are going up. So that's real world. That kind of hits you.
And interestingly, the Fed, so Powell was saying he thought financial conditions, including equity performance, were appropriately tightening. And so they're like, fuck the stock market, just let it do what it does. Because it appears as though they're
almost doubling down. When the market goes up, I feel like the Fed go out of their way to come out and just talk it down again. I mean, this has been pretty consistent trend. Yeah, no, they don't. Not their, and it's not their priority. They're not there to keep the stock market up. They're there to keep inflation.
Yeah, but I mean, there is a wealth effect there. But look, let's keep going with the doom and gloom, and then I'd like to prop it up a little bit with some positive outlooks later on.
Yeah,
so I'll hand over to you.
All right. So down prices are down to steal Coles' catchphrase there. So this chart I'll bring up here from Jim Reed at Deutsche Bank, and I'll just note I've read 4 different articles that have referenced this chart. This seems to be quite a popular one at the moment. So 2022 is shaping up to be one of the worst years on record, or financial years in the stock market.
The first half, he says.
The first half, exactly. So, the US share market's down, 25% last week. It's now just a smidgen over 20 or 21%. But at this point, so the first half performance since 1932, with the depths of the Great Depression. So that was the only period where we've had a first half worse than what we've just gone through, which was, sorry, have I got that right? Yeah.
Yeah, no, that's right.
Yeah. So, so 1932 down 22.3, 1962 down 22.2, and now what we've got at the moment. So, historically pretty bad, but what was really interesting about his note is, as I said, if you're looking at first half and second halves, typically what we're seeing is when we've had periods like this in the first half, we've seen exceptionally strong second halves. So he's called out 5 instances in the second half. So bear with me. I'll go through the numbers. But essentially, on average, when we've had a major first half decline like we've had, the second half on average has been about 17%, which is an interesting number. Up. Yeah. So 1932, first half was down 45%, second half up 56%.
From what point?
From the
low. Right.
Yeah.
Okay.
So 1962 down 22%, second half up 17%. Didn't recapture it, but the declines didn't continue. 1970, first half negative 19, second half up 29%. 1940, first half down 17, second half up 10. 39, first half down 15, second half up 18.
Bullish.
I mean, whether this time is different, I mean, that's always the question, right? So they just make a note here. Second half is probably quite binary. If you don't see a recession materialize over that period, it might be tough for markets to continue to be as bearish as what they've been, and the bounce back will quite likely happen. However, if there's strong evidence that we are in or going into recession, their expectation is there could be further downside. And they've mentioned this a few times, that I think they were saying that second half might be all right, but the first half of next year might be tough because we get back into go into a recession.
But isn't that what the market's pricing in right now, a recession?
Yeah, I think
so. How much?
But I wonder whether, and I was thinking about this earlier in the week, what we've had is, I mean, if you look at it as just a pure price to earnings equation, we've had the price decline and earnings have stayed where they are. If we go into recession, it's pretty reasonable to expect earnings are going to drop. So the S&P in the US, their PE ratio on average for the index has gone from 20 down to 16.5 or so.
To average.
To average, yeah. But if you get a decline in earnings, then that PE ratio jumps unless prices fall, by the same percentage. So I
But
think markets are factoring it in. Sorry, but there is an earnings risk, I think.
You're 100%. So we talked about this in our Phantom episode. Earnings have not. Earnings are still
have held up,
peaked,
Yeah.
and analysts' expectations are for earnings to continue to hold and remain strong. You're absolutely right. The E on the PE has not come down,
No.
but and you're right. If that comes down, then either the price
ratio goes up,
well,
or the
depends
price
on
has to
price
react.
keeps going down.
Yep.
But you and I spoke about this last week. Was that on the PE ratio, even though it's on the long-term average, it never sits on the long-term average.
No.
Right?
You're right.
That's just the average.
Yep.
It doesn't sit there. And so it typically trades above or below.
Absolutely. And we were saying that it won't just stay there. It will come down and overshoot on the downside, like it comes back up and overshoots on the upside, because we're all human and emotional. We get excited or depressed.
I reckon markets are predicting earnings declines, and I think the markets are predicting and pricing in a recession. And I could be totally wrong. I don't know how much more things can go down. I think we've gone through the peak, if you like.
The peak of the pessimism?
Yeah, I think so.
I think you're probably right. And I think...
And most of the damage is done, I reckon.
And the speed of the decline is, outside of March 2020 is pretty historical. And it's not to say that the markets will rebound. They may just not fall, a whole lot further, and may trade in a range for a period of time before recovering. But no, I agree. I think the worst, touch wood, I hate to say this, the worst of it is over. Not to say we can't fall a bit further from here.
Let's talk about tech. And I'll bring this chart up from Sentiment Trader. Almost every tech stock is in a bear market. 90% of S&P 500 technology stocks are down 20% or more from a 250-day high. So what this chart is showing on the bottom pane there is a percentage of S&P 500 technology members in a bear market, and you can see how quickly it's skyrocketed up to 90%. In 2020, it was close to 100% of stocks, and you can see how it peaks at almost all stocks, technology stocks in the S&P 500 fall in a bear market, and all the way down to none of them.
Yeah.
And so we've gone from, if you look during post 2020 or in 2021, none of them obviously were in a bear market, so we're just on an absolute tear.
Yep.
And the top pane plots in a red dot. Obviously you can see that cluster. There's 4 clusters there. The big one is there in during the tech wreck. Just a couple of points I want to mention here is that where am I? Here we go. So Sentiment Trader go on to say, after similar signals, the technology sector showed positive returns across all time frames. On a relative basis, technology stocks underperformed the S&P 500 in the near term, which is playing out as we speak today. You mentioned before, NASDAQ's down 35, S&P 500's down 21. A year later, technology stocks were higher 88% of the time. And I got this other stat that I picked up. More than 90% of our stocks in the S&P 500 declined today. This was a few days ago. It's the 5th time in the past 7 days. This is from Jason Gopfert. He's the founder of Sentiment Trader. It's the 5th time in the past 7 days. The 5th time in the past 7 days. Since 1928, there have been exactly 0 precedents.
Wow.
This is the most overwhelmingly display of selling in history. And I think that really just sums up how pessimistic investors are right now, and how much markets have declined, although it doesn't appear that way on surface. A couple of other things I want to share. Again, we talked about this in the Phantom episode. This is a fantastic chart by Bespoke. It shows post-World War II S&P 500 bear markets, the start date, the date it fell by 20% and technically fell in a bear market, how long it took, when it ended, the days from the negative 20 to the end, and so on. But I just want to focus on the far right-hand side where it says S&P 500 change once the negative 20% threshold is hit, next week, next month, next 3 months, next 6, and next year. And have a look, focus on the next year, the 12 months out. The average on the bottom right-hand corner there is 17.7%, and the positive number is almost 80%. And what Bespoke is saying is historically, when we have these situations, 80% of the time, the market is up 1 year later. They're pretty good odds. And on average, they're up almost 20% during that time as well. And the average across all periods since 1945, it's just under 10% up 1 year later. Mm-hmm. And so going back to your point about if you've got time horizon, I think even a 1 year time horizon, things look...
At this point,
things look pretty optimistic. But I also think that the further we fall from here, the probability or the average return for 1 year from here, it becomes, I think, even stronger.
Yeah.
A couple of other charts I just want to bring up, and I want to get your take on it. Again, this one's from Bespoke. This one came out the other day. It's the first one is 15% plus quarterly drops for the S&P 500 post World War II. And the next one is 20% plus 2-quarter drops for the S&P 500 post World War II. I'm just going to read this from Bespoke. Are better days on the horizon? If the S&P 500 does end up closing out the quarter down 15+%, there has never been another instance since World War II where the index wasn't up over the following year. And so what that's saying, historically, it's a 100% perfect strike rate for a very strong, on average, somewhere between 26 and 32% return the next year.
Yeah, that's crazy. I hadn't seen this. Yeah, I mean, far out. It kind of just reinforces what we're saying, right? Once you have a decline of this point, of this magnitude, things look more and more positive. And
do you think then, numbers. So inflation's coming out, the next read we'll get in July, right?
July or August? Yeah, some point.
Yeah, I think it's...
July in the US.
Yeah, the US CPI.
July for June.
Do you think then if that number starts to come down, do you think that's it?
I'd like to think so. I do. Possibly. And I was thinking about this last night. So we've talked about before how last year the inflation numbers really kicked up around June, July, August in the US. So those monthly numbers were high. So we're now starting to circle high numbers. So it has to be higher for the inflation rate to keep going up, which...
Could that be possible?
It's possible.
What's the US
last month?
Gas is $5 a gallon? Is that
$5 a gallon? Yeah,
a ridiculous number.
But if the decline that we've seen in oil holds, and that sort of translates into petrol
June's
prices,
numbers.
June and then July, not only are we seeing we're circling higher numbers, but then we've got petrol prices coming down. It's not improbable to think we might have a couple of months of pretty big declines.
Do you think there'll be enough time to flow through to things like transport, food?
No, not that far. That'll take a bit longer. Right. But that immediate headline inflation number, I mean, that's pretty quick, right? Well, assuming petrol stations pass it on. But then you've got other things that we talked about again last week and I think I saw there was one of the investment banks here came out with some earnings downgrades for some of the retail companies here, saying, like in the US, we've got consumers feeling the pressure. We've got inventories building up because they ordered more because they couldn't get it through, and we're starting to see oversupplies, which the only way to get rid of excess stock is to sell it at discounts. And so maybe that adds to it as well. So it's certainly not improbable we see inflation drop by a decent amount in the second half. And if we do, central banks stop raising rates or stop raising them as quickly as they are, and that's great for share markets.
And we've also started to see house prices come down in Melbourne and in Sydney. Brisbane continues to go up in Queensland.
Yep.
And so maybe the Reserve Bank are also in a position whereby they can't keep hiking at that pace because it's going to cause a big problem.
Chaos.
Do you think this is the most widely predicted recession ever?
Yeah, everyone's on the same side of the boat.
So
I always think if everyone's on the same side of the boat, I mean, probably worth being on the other side.
I don't disagree with you. I think
to
have some sort of contrarian stance here.
Yeah.
Maybe the data. Well, we spoke a couple of weeks ago about remember the US a certain number of states need to have economic decline. There's never been a recession that has come without all those states being in
for
decline.
7 months or something.
For something like that.
Yeah.
That's right.
Yep.
So I'm not saying all the data is coming out supporting a recession, because that's not what's happening here.
Yep.
And maybe the market's looking much further and further out. Maybe we have this rally when inflation comes down and the recession actually hits next year, like we saw in 2000, 2001. That could possibly happen as well.
Yeah. Look, it's not a foregone conclusion. I think your big prediction last week.
What was my prediction last week?
That we weren't going into recession this year.
Yeah.
Which unless we're in recession this quarter, then.
Well, if we're in recession this quarter,
it's odds on.
If we've had negative growth,
negative growth.
We're in recession because Q1 was negative growth.
Ah, shit, it was too. So, that's right. We're already there. But I don't think this quarter is going to be negative. But yeah, I don't know.
And the only time we would know is if Q3, Q4 are negative, and you won't know until 2023 anyway.
Until Feb or March or something.
Because the data, and I reckon the markets have
taken off by then.
Markets have turned.
Yep.
Let's move on.
All right. So this is a rehash of last week. So there's a group of CEOs in the US called the Business Roundtable, CEO Roundtable. It's often referred to. And it's basically the top CEOs of US companies getting together and have a bit of a chin wag, talking about what they're seeing. It's all private, so they're not, it's not for public consumption. So they're probably a little more freer in their commentary and thoughts and a bit more candid about what they're seeing. So anyway, this is essentially an index of their economic outlook. So it goes all the way back to 2004, thereabouts. And you can see there it's come off from its highs, but still relatively high. We don't have an average there, but I'd say we're probably in line with where it has been historically. But I think, again, the trend is probably the key. So just a couple of individual notes or points to pull out of the information they had there. So as of early June, 177 leaders of America's biggest companies surveyed by the Roundtable were still planning to hire and invest at higher interest rates. So that's interesting. The bad news is their outlook has deteriorated rapidly compared to early March, where so it's the sixth fastest drop in the 78 quarters that the survey has been conducted. So they're still positive, but they're just not as positive as what they were, and a bit of caution creeping in there. So more executives pulling back on hiring and capital spending implies potentially a slowdown to the booming growth. And I think that's the key: is growth is booming in some areas of the economy, but it's unsustainable, as it is anyway. But in the current environment, it's absolutely unsustainable. But how far do we decline? So 50% of CEOs plan to increase employment levels in the next 6 months, and that's down from 68% the previous quarter. 47% say they're going to increase capital investment, and that's down from 60%. And 72% expect sales to increase, and that was 10% less than the previous quarter. So things are still positive, not quite as positive. But the footnote I'll put to all that: when Jamie Dimon, the CEO of JP Morgan, first joined, he asked some of the research guys at JP Morgan to go back and look at what has the Roundtable, as a collective expected, and what has actually happened. And probably not overly surprising, they weren't all that accurate. So having said all that, ignore what I just said, basically.
Well, to the comments before about Kellogg's and the CEO, I'm like, well, what insight do they have?
Yeah, well, true. That's right. So the next thing here I've got is US retail sales, which unexpectedly fell in May. So we'll bring this chart up now.
This could be the recession.
Well, it's fairly volatile, somewhat volatile. But anyway, so they fell. The expectation was for a 0.2 increase. It was a 0.3 decline. I think what was interesting is the April number had been revised down from 0.9 to 0.7. So there's a chance that negative 0.3 gets revised down to be a larger negative. Some of the areas that recorded the biggest decline were auto sales, so car sales, electronics and appliances, electronics and appliance stores, sorry. They saw a 1.3 decline. Auto sales were down 4%. So they're those big kind of one-off type investments or spending. So that's probably not overly surprising. And again, areas that saw an increase, not overly surprising. Retail sales rose at gasoline stations. Not a surprise. Petrol prices going up as they are. Food and beverage stores at 1.2. Food services and drinking places up 0.7. So people are still going out and spending on food and entertainment and whatever, but they're pulling back on car sales and big, white goods, etc.
Just say Qantas with their number of aircraft they're putting back out now.
I saw
they can't keep up.
Yeah,
90% of flights for the next 2 weeks are fully booked out.
That's absurd. And that's school holidays coming up. Yeah, right. Okay. So people are still traveling.
People are spending money, man.
Yeah, they are. They are. And just lastly, so we've referenced retailers and stockpiling of goods on hand or surplus stock. So this is one that follows up on what we talked about a couple of weeks ago. We'll bring the chart up now. So these are the retailers with the biggest absolute inventory gains over the last year, being 4 quarters, the last 1 quarter and just shows the trend of what's happening. Probably not overly surprising. If you couldn't get stock in 12 months ago, you can see a supply issue and shipping and all the rest of it. You order more, it slowly comes in. All of a sudden, the retail consumer is not buying as much. So you've got this surplus stock. We've seen this with Target. Walmart is likely to follow suit, you would imagine. And then they'll start discounting to get rid of the stuff and so on and so forth. But I think what's interesting there is Home Depot, which is the Bunnings equivalent over there in the States. They've seen an increase in inventory. We were chatting with someone earlier this week who was saying, getting timber is really difficult, for frames and roof trusses and all that sort of stuff. So it's interesting that, and especially over there where they've got enormous housing shortages, i.e. they're not building as many as they need to keep up.
Well, we've got that here as well in Australia, I think.
Yeah, absolutely.
No, I think that's a fact.
No, I think it is a fact. And I think it's about 50% of what we need is being built. So if we need 100, we're building 50. So yeah, it was just of interest. And then if I could sneak this last one in, I didn't know where to put this one in today, so I just shoved it in here. This is the 2-year, 10-year US yield curve. So you can see historically here that, we've talked before, that when that turns negative or inverts, it's historically been seen as a recession is possible 6 months out from that point.
Is that I can't see the full chart there, but I can't see the precise number.
Yeah.
Has that bounced up from zero?
I think it has. I think it maybe even dipped ever so slightly. And from memory, I think it went negative at some point, like a month or two ago. But it's bounced a little bit from there. But the current is, so the 2 years at 3.056% and the 10 years at 3.156. So it's only 10 bips. I mean, it doesn't take a lot for that to change, to dip it back into negative. So it may have bounced, but it's still thereabouts.
Yeah. Okay.
So is that the end of the doom and gloom? I think so.
Well, I think my positive spin on the forward expected returns is the positive spin. So the doom and gloom. We're living through it now.
Yeah,
you had to have predicted this on the 31st of December 2021.
Yep.
So we're here now. You can't do anything about it now. You have to more or less ride it out. Absolutely. That's where we're at.
Because all you're doing is locking in losses. And what do you do? Sit in cash? And then the market goes up. What do you do? Sit there and not believe it?
And your cost of...
Well, inflation's going up.
It's not...
And then the market bounces and you're like, this is not sustainable. It'll fall again. I mean...
That's right. Let's jump into director's cuts. What do we got today?
All right. So the Reddit crowd are back at it. So Revlon, the makeup company.
Oh,
yeah. They filed for bankruptcy not long ago.
When did that happen? Revlon.
A couple of months ago.
Right.
Yeah.
Didn't even know.
So filed for bankruptcy protection a couple of months ago, and the Reddit crowd have jumped on board, driving their stock up to gains of about 800% from their lows. And this has been, I think, the highest trending topic in Reddit Wall Street's bets behind GameStop. I think that's still trending. And we've seen this before with Hertz last year. Hertz filed for
Kodak
bankruptcy.
Kodak. There was Kodak trading as well. I think with some of their trademarks or their IP.
Yep. So Hertz last year filed for bankruptcy. The Reddit crew jumped in like crazy. I don't know if they made money or not, but
so what?
Anyway.
Just so I understand, what are they doing?
Well, they're buying options. They're buying out of the money long dated options,
right?
Which forces the market makers to provide cover, and then they have to buy the actual stock, which pushes the price up. And the closer it comes to win the money, the more they have to buy, and so on and so forth. And I'm sure some of them buying. Why did they go bankrupt? Shares as well? I can't recall.
Yeah, that's interesting.
I don't know. So yeah, that was one thing that caught my eye. What about you, mate? What do you got?
What have I got here? Let me just get this one up. JP Morgan, did you see that? We're firing.
Yes, I did see that.
But I think I read that. I think you put that in the doc. But the thing that caught my eye, Lego invests $1 billion in first US factory as brick sales grow. What do you think about that? What do you think about Lego?
Mate,
it's a classic.
It's
like, what
timeless,
is Lego?
Right?
It's not a game. It's just
activity.
Lego is an activity, and it's just a fascinating concept. My kids are watching
Lego Masters.
No. They watch Brightside. It's like on YouTube, I think it is, and they talk about different concepts and like quirky facts, fun facts. And I don't know, they were saying, my 8-year-old saying that some Lego pieces, do they have holes drilled in the Lego pieces?
I don't know. I think some of them, right?
Yeah, apparently it's supposed to, if kids swallow them, it's so that air can go through the actual,
and they can still breathe.
Yeah,
is that right?
Yeah,
far out. That's interesting.
I mean, if we think about this doom and gloom, and then here we are with a solid business. Lego, are they Swiss? Is it a Swiss company?
Norway, somewhere there.
Investing $1 billion in their first US factory. I'm just wondering, everyone talks about the US is dead. I don't know, like
a lot of money.
May not necessarily be the real story.
Yeah. The JP Morgan one was interesting. I threw that in because of the home lending. So that's out of their mortgage division.
We spoke about that last week, didn't we? The week before, about the number of loan applications in the US that have taken an absolute plunge.
Yeah.
So that was episode 20. We spoke about that.
Okay.
And then this is now JP Morgan coming out. And
so
how many people are they laying off? 1,000 US workers.
Okay. So Compass,
doesn't sound like a lot, does it? 1,000.
Not a lot. Well, I don't know. I don't know what percentage of their mortgage business that is. But Compass, who's another like business in terms of mortgage writing and providing, and Redfin, which is another one. So Compass getting rid of 10% of their workforce, about 450. Redfin 6%, about 470. So there's definitely a trend here that mortgage applications are falling off a cliff, and that's not a huge surprise, right? I mean, interest rates we saw 30-year fixed rates in the US have gone from 2.5 up to above 5%.
Yeah.
No surprise. All right, we've got a couple more. What else?
What else you got here?
Do you want to take this one? The Internet Explorer. Bye-bye.
No, you got that one, because I just thought I'd throw something else in there.
So we'll just bring up this graph chart just briefly.
Not going to respond.
So Internet Explorer, I don't know, it's kind of the one that I always had thought about as search engines. Obviously, they've vanished, as you can see here by the numbers. So Internet Explorer accounts for 0.8% of the search engine market. Back in I'm going to say it's 2008, they were like 70, nearly 70%. And look at the rise of Chrome and Google there. It's just crazy. Safari, which is the Apple search engine, 9%. I mean, I think that just speaks to the power of Apple.
Why do they even try? It's like car companies, how they try and make their own navigation. It's like, what are you doing, man? Just use Google Maps.
It's not worth it, right?
Why are you wasting time?
I don't know.
Do you know Bill Gates, I think, was quoted sort of talking about how Bitcoin is this useless thing and what does it do and what a dumb idea. So I came out and said, well, who invented Internet Explorer? So it was something along the lines of this coming from the man who invented Internet Explorer, just as Internet Explorer is being shut down.
Perfect timing. Anyway, so goodbye, Internet Explorer. You are done.
Deutsche Bank. I read this, this was on Bloomberg the other day, and I'll just quote this from Bloomberg. Deutsche Bank AG's private banking business expects to upgrade its view on Chinese stocks in coming months as it sees US inflation peaking and calm returning to global markets. I don't know if you've seen Chinese markets, but they've been rallying since mid-May.
Yes.
So they're 4 weeks behind, in fact, 5 weeks behind Deutsche Bank's private banking business. Quote, this is from, I don't know, the CIO or something. I want to see markets calming down. Inflation not going further, and then we can move into China.
Good job. It'll be too late.
But it's like, isn't everyone watching that? Like, what insight do you have that no one else has? And I bet you the market would have moved before the markets calmed down. We've already seen Chinese stocks rally hard since the 16th of May.
Mm-hmm. Yep.
So anyway, I thought that was, and people are reading this stuff, right? People are taking,
of course they are,
this advice because it's perceived that this person has more insight than millions of global market participants. Like, I don't know what insight these people. Anyway, I thought that was just worthwhile shouting out because it doesn't make any sense to me.
No, it doesn't either. And I think this is the last one. Man, I've got a few today. So the CEO of Chevron, Mike Wirth, came out and wrote a letter to President Biden. And one excerpt from that letter, which was pretty interesting. So, notwithstanding these efforts, your administration has largely sought to criticize and at times vilify our industry. While today's geopolitical situation is contributing to the energy crisis, bringing prices down and increasing supply will require a change in approach, which I thought was fascinating. And, we're seeing energy crisis all over the world at the moment. I mean, we're just seeing it here in Australia. We're seeing it in Europe and certainly in the US as well. So there's just a chart here that we'll just bring up really quickly. The oil price versus inflation. And while it's not a perfect correlation, it's pretty damn interesting. So when oil peaks or is rising, there is generally a fairly strong correlation to inflation. Again, not perfect, but it's certainly there. And you can see since 2020, I mean, it's almost perfect unison.
But based on this, is this inflation that we're seeing and feeling right now because of the so-called money printing since 2008, 2009, and more recently since the COVID crisis? Or is this an energy thing with supply, demand, etc.? I'm only asking the question because you show me this chart. I've never seen this before, and it's quite interesting. And the correlation looks pretty high.
Yeah.
What's leading what though?
Yeah. Well, I think that's the question.
Is there like a lead lag? It doesn't say anything about that.
Not at the moment.
It's just plotted them.
Spot on. Yeah, you're right. It doesn't. But to your question, oil has a massive contributing factor to inflation at the moment, and supply shortages. How much has money printing contributed to the demand for goods that have led to the supply shortages? I know that you could probably debate that all day, but
it's like saying let's raise interest rates because the cost of lettuce has gone up. Interest rates don't change the weather patterns. We still have floods, so
yes,
we're fighting this battle over here, but the war's over here. We're not on the same battlefield.
Yeah, no, I think you're right to a point. Lettuce prices drop if no one is buying them, right? And so no one's buying them because they can't afford it because their mortgage is now $1 gazillion a month. So I agree with you. I do. But a reduction in demand will have some impact, but it's not going to be everything.
Yeah.
I mean, oil, as we saw before, that's a major part, and supply chain issues easing up, which I don't know if they're as big a thing as they were, but maybe that premium for shipping is still in there.
Do you also think we're sort of living in this primitive world whereby we're using, let's call them fossil fuels, And what if we have this shift to cleaner energy? What impact could we have less these boom bust periods where you've got clean energy, electric?
But it's never going to, well, I don't say never. It's going to take ages, like
Yeah, sure.
decades for it to be 100% clean. And I think, I heard that Germany are now opening some of their coal mines because they just don't have the, I mean, so yeah, I don't know. Possibly, but we're still going to need some sort of backup gas or something for when, the sun's not shining, the wind's not blowing, whether it be winter or whatever it happens to be.
Yeah, but there's all that stuff gets stored in batteries. But then again, there's an argument to say, well, how do you then make the batteries? Because you need lithium, you need nickel.
And how big does a battery need to be to supply Melbourne for 3 days? I mean, that's absurdly big. But who knows? Technology will advance, and the solution's out there somewhere, I'm sure. Well, but it's going to take a while.
Elon Musk is giving everyone free internet, solar panels, cars. I don't know what else he's going to be dishing out.
What else?
Products.
The challenge is yours, Elon. Step up, man.
All right, let's tips and recommendations. What do you got for us today?
All right, I've got. I'm going back to last week. So long weekend, went down to Phillip Island, and we went to the North Pier pub, I think it's called.
Yeah,
Phillip Island. It was quite good. I think I mentioned last week. Quite enjoyed watching Game 3 of the NBA playoffs. Watching the Warriors.
Who won that game?
Warriors beating the Celtics.
It's
quite entertaining, but it's a pretty cool pub. I don't think I'd been there before, or certainly not for a long time. Big open, food was pretty reasonably priced, service was pretty good. They were pumping though, man. They were so busy. It was a wet, cold Phillip Island weekend.
It's nice to be down.
I love being on the beach when it's wet and windy. It's pretty
people
cool.
Say, they don't go to the Mornington Peninsula unless it's summertime, but going down to places like that or Mornington or wherever in wintertime, there's just this nice feeling about it.
Yeah,
I don't know what it is.
Totally different vibe, but it's still, I quite enjoyed it. Anyway, so the pub was good. They had a number of gluten-free options, a few vegan options.
Yeah, nice.
So, yeah, well worth going. It's just a great little spot. We stayed at Smith's Beach, which I kind of prefer to be away from the cows' hustle and bustle.
Why?
Not hustle and bustle. I don't know. I'm going down there to relax and just get away from it all. Just sit down there and just kick back. Not have to worry about, going to cows, get some food, and then just that's it. Anyway, so it was a decent pub.
I'm just trying to remember what my recommendation was for last week.
He's back on board Netflix, people. This guy.
Okay, that's right.
They sucked him back in.
So just for everyone, as you probably know, I got an email from Netflix saying, so we're sorry to see you go. Deb cancelled Netflix. And the good thing, I mentioned this last week, Netflix do is that it's not an immediate cancellation. So I think depending on your subscription day, you've got this up. We had up until the end of June, so we've got some time to subscribe. But so obviously we're still continuing to get the alerts for the new movies. And I had Hustle. Adam Sandler pop up, and I thought I have to watch this before the subscription ends. And so I watched the Adam Sandler Hustle movie. And have you watched it yet? Not yet?
No, not yet.
But man, it was such a good movie. It was not, for anyone who hasn't watched it yet, it wasn't a typical Adam Sandler stupid funny movie. It was quite, I don't know, I feel like he's matured in a sense.
In his old age,
he's got the beard going, and he looks good. Like, his acting is good. He still throws in a lot of his Adam Sandler jokes, but I feel like they're far more appropriate for whatever's going on at the time. Yep. So he's a basketball scout. For the Philadelphia 76ers, he gets promoted to assistant coach. The owner dies. His son comes in. He throws him back into the wild, scouting again. And he finds this, and he goes around the world scouting, and he finds this guy on the streets of Spain playing street ball, tries to get him into the NBA draft for a whole variety of reasons. He can't. What I didn't know that you told me, the guy that plays the Spanish basketball
Hernan
player, Gomez, unique Spanish names.
Hernan Gomez?
He plays himself.
Yes.
And what was fascinating for me was, one, it was a bloody good movie. It was a bit of a feel-good, support the underdog kind of movie. It was about 2 hours, I think, as well.
Yep.
But Adam Sandler's, and we're chatting about this in the office, Adam Sandler's ability to be able to get and round together just super high celebrities, like A-class celebrities in his movies. It's just insane. And he's still doing it.
Yep.
I think I mentioned Dr. J, Julius Erving was playing himself.
Yeah,
Shaquille O'Neal, Charles Barkley.
Sir Charles, love him.
Man, it was so good.
Yeah, there's quite a lot of NBA dudes, but just general celebrity. I mean, he always does it, right?
Who plays
and
his
normal cohort?
Is it Queen Latifah? Who plays his wife?
Is his usual cohort of mates in there as well? I'm sure they are.
No.
No? Come on, man.
The Billy Madison, Happy Gilmore.
51st Dates, all those guys. They're always in them.
Who's the guy where he's playing Happy Gilmore and he gets the nail in his head?
Oh, yeah, that dude.
It's okay, Mr. Gilmore.
Yeah. Big, massive,
goofy guy.
Giant dude. Yeah. He pops up. He's like, I don't know. I feel like he was in a Bond movie. I don't know. He was a villain or something.
I can't remember.
Anyway. But he's like Jim Carrey. Remember Jim Carrey did all the Ace Ventura and all those movies. And then as his career kind of evolved into more serious roles with a little bit of comedy here and there.
What movies has he been in lately?
Who's that?
Yeah, Queen Latifah's his wife.
Oh, yeah.
Adam Sandler's wife in the movie. But man, there's heaps of Juancho, Herman Gomez. Is Bo Cruz in the movie.
Yeah, right.
I haven't seen Adam. Who are you talking about? Jim Carrey.
Oh, Jim Carrey.
I haven't seen him for a long time.
Yeah, I don't know. Last time I saw him, it was in Jerry Seinfeld does the driving around in cars with comedians and drinking coffee or something like that. Yeah. Anyway, man, this dude he's just off the charts.
Is he?
He's a unique individual. Anyway, we're massively off topic.
Let's start wrapping up. Massive shout out to the guy out on Elizabeth Street playing the drums. He's been going all morning
with his bucket.
What's he playing? Buckets.
Bucket.
It sounds like it's
something.
Sounds like it's Chinese New Year. Not quite. Where you've got in
his mind it is
the dragons and the drums and whatnot going. So if you've heard any music in the background, massive shout out to the guys down on the streets playing the drums. It's not the drums, it's buckets. What's he using? Is he using spoons?
I don't know. Anyway, whatever he can find.
Melburnians will know who we're talking about. Hit us up on YouTube. Probably YouTube is where we're getting most of our listeners. So keep it up. Thanks for supporting us, and we'll see you next week.
Cheers, guys.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.